S corporation requirements. Let's go over S corporations in general first. The rules governing S corporations are found in subchapter S of the Internal Revenue Code. That's why they're called S corporations. The rules for C corporations are found in subchapter C of the Internal Revenue Code. Two different code sections. An S corporation has similarities to both a C corporation and a partnership. It's kind of like a hybrid between those two entities. It's not the same as a partnership, even though income and loss passes through, and it's not the same as a C corporation, even though an S corporation is a type of corporation. It has aspects of both of those types of entities, okay? Like a partnership, an S corporation is a pass-through entity and is generally not taxed on its earnings. Instead, income and loss is passed through to the shareholders. However, unlike a partnership, the shareholders in an S corporation are not considered self-employed. They're either employees or investors in the corporation. An S corporation can have investors just like a C corporation, but it's really limited to the number of investors it can have. S corporations have a shareholder limit, while C corporations don't. So an S corporation can potentially have investors just like a C corporation can. Most of the time, however, when you have an S corporation, the number of owners are small, and those owners are also working in the business. It doesn't always have to be that way, but generally that's how it is. 99% of the S corporations in the United States have fewer than 5 owners. Most of them. And then more than 90% just have 1 owner. Okay, so S corporation is a very popular entity type for single owner businesses. Shareholders of S corporations report the flow through of income and losses on their personal tax returns and are assessed tax at their individual income tax rates. This allows S corporations to avoid double taxation on corporate income. S corporations do have drawbacks. S corporations, I feel, are a great entity type for a small business where there's just a single owner. And I think that when you start having multiple owners in the mix, that's sometimes where S corporations are not as desirable. Let's just say it that way. Because S corporations do not allow any kind of flexible allocations. The owners of the company who are working in the company have to be paid wages like employees. There's much less flexibility with an S corporation versus a partnership. And then, of course, S corporations don't get the same fringe benefit perks that C corporations do. I think S corporations are really good for single owner companies. It's just one owner and maybe they hire a spouse or whatever. That's fine. I feel like S corporations have a lot of limitations, especially once a business starts to get profitable and wants to grow. But it is a very good entity type for a small business owner where it's just one owner and maybe a couple of employees or maybe just a spousal employee. Then I think S corporations are great in that scenario. Okay. S corporations do have drawbacks. They are less flexible than partnerships. For example, in a partnership, the partners can have different allocations for income and loss based on their partnership agreement. There's none of that kind of flexibility with an S corporation. And in fact, if you do have unequal distributions where the shareholders, if it's more than one shareholder, right? Okay, I want you to understand this. If it's just one shareholder, if it's just one owner, you don't have to worry about unequal distributions, none of that. Problems start to arise with S corporations when you have multiple owners in the business and then they're taking unequal distributions. You can't do that. You can't do that with an S corporation. That's a terminating event. It will terminate the corporation's S status. And then what ends up happening if you have a terminating event, that's a catastrophic event. And the corporation doesn't go back to being an LLC, or if it's a multi-member LLC, it doesn't go back to being something else. What ends up happening after a terminating event, if the S Corp election terminates, then it becomes a C corporation from that day forward. And the most common type of terminating event for an S corporation happens to be situations where you have multiple shareholders and there's unequal distributions, where the distributions are not being made according to ownership stake. You can do that with a partnership. You cannot do that with an S corporation. With an S corporation, profits and losses must be passed through to the shareholders based on their percentage of stock ownership. There's no exceptions to that rule. Shareholders can't make any special agreements or arrangements for allocating profits and losses in an imbalanced manner. Unlike C corporations, an S corporation can only have one class of stock. One class of stock. Remember this for the test. An S corporation can only have one class of stock. A C corporation can have preferred stock, common stock, multiple classes of both of those types of stock. You can have preferred stock A, preferred stock B, preferred stock C. With a C corporation, that's possible. An S corporation cannot have more than one class of stock. Every single shareholder in the S corporation has to have the same distribution rights. The only differences that the stock can have is differences in voting rights. That's it. That's the only difference that's permitted. But everybody has to have the same rights to distribution proceeds and to income and losses. Everybody's stock has to be the same with regards to income and losses. The only difference that's permitted with an S corporation is differences in voting rights. That's it. S corporations also have very strict limits on the number of shareholders and the type of shareholders that the company can have. A C corporation does not have any shareholder restrictions. It can have any type of shareholder that it wants. C corporations. S corporations have very strict limits on the number and the type of shareholders that are permitted to be shareholders in an S corporation. There are some instances in which an S corporation is forced to pay tax on its earnings, just like a C corporation, although these instances are rare. And most of the time you will not see these. The only time really that you have an S corporation that pays income tax is when it was a C corporation in the past. If an S corporation has always been an S corporation from the very beginning, from its inception, then it's not going to pay tax on its earnings. Because the time when a corporation pays tax on its earnings, an S corporation, is when it used to be a C corporation in the past, and it still has some accumulated earnings or stuff going on from when it was a C corporation. An S corporation may choose to use either the cash or accrual method. Either accounting method is fine. The S corporation can choose, but S corporations do have a required tax year, unlike a C corporation. Generally, an S corporation has a required tax year. And I'm going to go over all of these concepts in this webinar. Required tax year. Now, partnerships and S corporations have a required tax year. An S corporation can choose to use either cash or accrual method of accounting, but it has a required tax year. Generally, an S corporation must have IRS permission to use a fiscal year. S corporations can be on a fiscal year if they have like a natural tax year, like a seasonal business, for example, but generally they have to ask the IRS in advance in order to use a fiscal year. An S corporation may always use a calendar year or any other tax year for which it establishes a bona fide business purpose, like a natural tax year or a seasonal business. That would be okay. A new S corporation must use Form 2553, election by a small business corporation, to elect a tax year. And let me show you where it is on that form. So here's the form that companies use in order to elect S status. This is the Form 2553. So for example, if you have an LLC and it wants to be treated as an S corporation, you fill out the Form 2553. Or if you have a corporation that you've formed at the state level and the corporation wants to be treated as an S corporation for federal income tax purposes, you would fill this out as well. And the name goes here, the employer identification number, the date that the business was incorporated at the state level, that's what you would put here. And then usually you would use the same date down here. The election is to be effective for tax year beginning, blah, blah, blah. And I'm going to give you some examples of this. Although you can have a situation where it's a corporation or an LLC that has already been in existence for several years and then wants to make an election in the current year. And in that case, you would use the election date, for the current year that you want it to become effective. The selected tax year goes here. As you can see, the calendar year is the number one. It's the first choice on the list. And 99.9% of the time, almost all the time, you're going to have a calendar year S corporation because the S corporations have to have the same tax year as the majority interest shareholders. That's what a required tax year means. And since most of the time, the shareholders of S corporations are humans, natural persons, although there are some entities that can also be shareholders in an S corporation. I want you to realize that. Just most of the time, it's going to be humans. And since humans are on a calendar year, then that's the box that you're going to check here too. There is a possibility sometimes for S corporations to have a fiscal year, especially if it's a seasonal business. Like I said, a natural tax year is possible. It's just not commonplace. The main requirements for S corporation status are: it must be a domestic corporation, which means it must be a U.S. corporation. No foreign corporations can be S corporations. It cannot have more than 100 shareholders. Shareholders generally must be U.S. citizens or U.S. residents if they are individuals, or certain types of trusts, banks, estates, or certain tax-exempt corporations. Corporate shareholders and partnerships are generally excluded. So a partnership cannot be a shareholder in an S corporation. And a corporation, in general, cannot be a shareholder in an S corporation. There are two exceptions to that rule. Tax-exempt corporations, these are 501c3s, can be S corporation shareholders. In contrast, an S corporation is allowed to own a partnership interest or own stock in a C corporation. S corporations can invest. It's perfectly fine for an S corporation to invest. So an S corporation, the S corporation itself, can purchase a partnership interest or invest in a partnership. Then the S corporation itself is a partner in a partnership. S corporations can buy stock. For example, my S corporation could purchase stock in Ford or Tesla or any publicly traded company that it wants. Then the S corporation is a shareholder in a C corporation when it does that, right? If it buys stock in a publicly traded company, then it becomes a shareholder in a C corporation. That is perfectly fine. But the same does not hold true in reverse. A C corporation cannot be a shareholder in an S corporation, with the exception of tax-exempt corporations, which means 501c3s. Non-resident aliens cannot be direct shareholders in an S corporation. An S corporation can only have one class of stock, but that stock can have differences in voting rights. Profits and losses must be allocated to shareholders in proportion to each one's interest in the business. And all shareholders of an S corporation must give consent for the S election. Now, with regards to the 100 shareholder limit, this is a hard limit. This is the maximum number of shareholders that an S corporation can have is 100. Remember that for the test. However, with regards to this limit, related persons can be considered one shareholder. So members of the same family can be treated as one shareholder for the purposes of this shareholder limit. Spouses are automatically treated as a single shareholder if they wish. So you can have a married couple treated as one shareholder. And then a family, defined as a group of individuals descended from a common ancestor, plus spouses and former spouses of either the common ancestor or anyone lineally descended from that person, is considered a single shareholder as long as any family member elects such treatment. Now, when they're talking about former spouses here, they're talking about deceased spouses, because if spouses divorce, then they're not treated as a single shareholder anymore, or they can't be treated as a single shareholder anymore. It's only if your spouse dies, then the estate of the deceased spouse is still treated as a single shareholder along with the living spouse. Does that make sense? Okay. It can be like my husband and I, and then our kids, and then even our grandkids and our great-grandkids. It can go down multiple generations where you can have the entire family, or our entire family, could be treated as one shareholder for the purposes of this one shareholder limit. I personally have never seen an S corporation this large, where it was over 100 shareholders, but it was still within the 100 shareholder limit. I did take a CPE course this year, actually, from a very good instructor who was specialized in S corporations. And he said that the largest one he'd ever seen was around 400. So it is possible to have a situation where an S corporation is still treated as having 100 shareholders or less than 100 shareholders, but you're actually filing more than 100 Schedule K1s, because you'll have like 5, 6, 10, 15 people being treated as one shareholder for the purposes of this limit, because they're all members of the same family. And it can be several generations. In one of the groups that I belong to, last year, I think one of the accountants in that group said that she had one that had 112. Well, 112 Schedule K1s, but they were still under the 100 shareholder limit because they had members of a family being treated as a single shareholder. 10, 15, sometimes even 20 people, because you have the kids, the grandkids, the great-grandkids. They can also be treated as one shareholder for the purposes of this limit. When a shareholder dies, the deceased shareholder's spouse and the estate are still considered one shareholder for the shareholder limit. However, spouses cannot be considered a single shareholder if they divorce or if the marriage is dissolved for any other reason than death. They're talking about something like an annulment, too. An annulment invalidates the marriage, so that in that case, it would be similar to a divorce, where the spouses are no longer related parties, right? They're basically treated as strangers after a divorce or after an annulment. They're not related parties anymore. So then they wouldn't be treated as one shareholder anymore. They would be treated as two separate shareholders. Therefore, a shareholder's divorce can potentially increase the number of shareholders to a number in excess of the 100 shareholder limit. And once you go above this limit, it can't be an S corporation anymore. The day that it goes over this limit, that day, once you go over 100, it becomes a C corp. That's a terminating event on that day. If an S corporation fails to meet this restriction, the S election is considered terminated, and the S corporation ceases to be an S corporation and is instead taxed as a C corporation from that day forward. And this is a mess. You don't want this to happen. This is a mess if this happens. What ends up happening is it's a terminating event on the day that this terminating event occurs. It's an S corporation for that first half of the year or whatever part of the year before the terminating event. And then it's a C corporation for the other half of the year. So you have to file two tax returns in the same year with the same EIN. One of them has to go in on paper, right? The C corp return has to go in on paper after the terminating event occurs. So it's a gigantic mess. You never want this to happen. But sometimes it happens. That's what a terminating event is. We're going to talk more about that in this webinar. But if you go over 100 shareholders, 101 or more, that's it. No more S corporation. Becomes a C corporation from that day forward. Ownership restrictions. Now, there are very strict rules on who or what type of entity or people can be shareholders in an S corporation. An S corporation generally can only be owned by individuals, and those individuals have to be either a U.S. citizen or a U.S. resident. Non-resident aliens cannot be shareholders in an S corporation. Or trusts or estates. S corporations cannot be owned by another S corporation, a C corporation, or a partnership. Once again, we talked about that exception where a 501c3 can own S corporation stock. That's okay. However, there is one other exception to this rule. It's where an S corporation is allowed to have another S corporation as a wholly owned subsidiary. This is called a qualified subchapter S subsidiary, also referred to as a QSSS, 3 S's, or a Q sub. For example, if one S corporation acquires another S corporation, the acquired S corporation can be treated as a subsidiary by filing a proper election form 8869. The acquired S corporation is called the subsidiary, while the purchasing corporation is called the parent corporation. If a proper Q sub election is not filed, then the acquired corporation will be treated as a C corporation for tax purposes. So apparently, this is a pretty common screw up where one company will try to acquire another corporation and treat it as a subsidiary, but the paperwork is not filed correctly. The only way an S corporation can own another S corporation is if that corporation, the parent corporation, owns 100% of the other corporation. It can't be a situation where some of the stock is owned by someone else, by another company or by another individual. That's not possible. If one S corporation wants to own another S corporation, it has to own the whole thing, 100% of the stock. And it's just treated as one corporation, a single corporation for tax purposes. They just file one tax return, if that's the case. If it's an S corporation that owns a wholly owned subsidiary and it's another S corporation. So you have like an S corporation at the top, and then it can own multiple S corporation subsidiaries at the bottom. And the reason why they do this, that I have experience with, in my experience, is just for legal reasons. And it's really common with franchise restaurants. This is where I've seen it. You have, like a parent corporation that's an S corporation that might be owned by a family, and they own a bunch of restaurants, and they want them all to be treated as S corporations because they want pass-through treatment, right? What ends up happening is they want legal protections, but then they want all of the restaurants to be treated as S corporations, so they have to put them all under the same umbrella. And you'll have the parent S corporation at the top, and then you'll have, 5 or 6 franchise locations at the bottom, but they're all S corporations and they're all wholly owned by the parent S corporation. Okay, they do it usually for legal liabilities reasons. So you'll have each one of these as a separate corporation for legal purposes, but they have an S election, all of these little subsidiaries down here. So if one of them has some catastrophic legal problem, then the parent corporation is protected from lawsuits. But for tax purposes, they're all treated just as one S corporation. Got it? Okay. Filing requirements. An S corporation files its tax return on Form 1120S. 1120 is a C corporation. 1120S is an S corporation. Allocated amounts of income, deductions, and credits pass through to individual shareholders and are reported on Schedule K1. S corporations have Schedule K1s because it's a pass-through. C corporations do not have Schedule K1s. There's no Schedule K1s for a C corporation because it's not a pass-through. If a C corporation issues anything, it's going to issue a 1099 div, like for dividends, or maybe a Form W-2 for wages that it's paying its employees, but none of the income passes through. S corporations have Schedule K1s, and C corporations do not. The return must be signed and dated by an authorized corporate officer. Notice that it doesn't say shareholder here. Okay, that's the same way with a C corporation. It's a corporate officer that has to sign. A corporate officer, not a shareholder. Now, many times, especially with S corporations, the corporate officer is the shareholder, right? Corporate officer is the shareholder. You might have just one corporate officer and one shareholder. That's very common with small S corporations, right? But what if you have a large S corporation and there's 75 or even 100 shareholders? You can have 100 shareholders with an S corporation. Not all of them are going to be officers, though. So it has to be a corporate officer. This means president, vice president, treasurer, secretary. Corporate officer has to sign, okay? Or in certain instances by a fiduciary, such as a receiver, trustee, or assignee on behalf of the corporation. And this would occur if you had a situation where maybe the shareholder died, the founder of the company or the president of the company died, and then the shares passed to the estate. And then sometimes the executor is the one that's going to have to sign because the executor is the executor of the estate. And now the estate owns the shares of the S corporation. Okay, so that can happen too. An S corporation is always required to file a tax return regardless of income or loss. Corporations always have a filing requirement, not like partnerships. If a partnership has no activity, and I mean zero, not even $1 of activity, no income or loss, then the partnership technically does not have to file a tax return. If it has no activity, if a partnership has no activity, it doesn't have to file. Corporations are not like that. Corporations have to file a tax return every single year, regardless of income or loss. The filing requirement ends only when the corporation is legally dissolved. When you get that dissolution paperwork from the Secretary of State, that's the final tax year, and then you don't have to file any returns after that final year. But until you have that dissolution paperwork in your hot little hands, that corporation has a filing requirement. Okay? The tax return is due on the 15th day of the third month following the tax year end. For a calendar year S corporation, the tax return is due March 15th. This is 99% of the time. They're due on March 15th. And this is the same filing deadline for partnerships. Remember, C corporations, it's April 15th. If they're calendar year. S corporations and partnerships, it's March 15th. A 6-month extension of time to file can be requested using Form 7004. And then with the 6-month extension, then the extended deadline is September 15th. To become an S corporation, a corporation or other eligible entity must file an election on Form 2553, election by a small business corporation, basically immediately. It has to happen basically immediately after the formation. You're supposed to file this form right away. Otherwise, it's considered a late election. And I know that late elections are really common, but the IRS has been screwing them up a lot lately. So I do recommend that if you are going to elect S status, you should do it as soon as possible, which means you should do it on time. The filing must be made no later than the 15th day of the third month after the start of the business's tax year, the corporation's tax year, for the election to be effective at the beginning of the year. So if you formed a corporation at the state level right? It's a C corporation by default. And then if you want it to be treated as an S corporation, you need to file that Form 2553 right away, within 2.5 months, the 15th day of the third month after the start of its tax year. Immediately after you get that paperwork back from the Secretary of State, you should be filing this form if you want it to be treated as an S corporation in the first year. Let me give you 2 examples of how an S corporation can make an election on time. Example number 1 is when an S corporation has no prior tax year. They have never filed before, and it's newly incorporated. Milltown Minerals, Inc. is a newly formed corporation that incorporated on January 9th, 2024. So it's just incorporated in 2024, and it wants to be treated as an S corporation immediately from its inception. In order to elect to be an S corporation beginning with its first tax year, Milltown Minerals must file Form 2553 anytime between January 9th and March 24th, within 2 months and 15 days after the start of its first tax year. It was just formed on January 9th, which means the first year is going to be a short tax year. It's not going to be a full year. The first year starts with January 9th and goes all the way to December 31st, if it's a calendar year corporation. So the first year is a short tax year, and the corporation has to file the 2553 right away. And I go over an extended example of this in the bonus videos folder. If you have access to the bonus videos, there is a video there that shows you basically how to fill out the Form 2553. You won't have to fill out the Form 2553 for the EA exam. We don't tell you how to fill it out in these webinars because these webinars are just designed to teach you how to pass a test, and you won't have to fill out any forms or anything like that for the EA exam. But if you want to know how to fill out a Form 2553, there is an example of that, and there's an extended S Corporation webinar in the bonus video folder if you want to know more. Basically, the corporation has to fill out the Form 2553 right after it's formed, and generally it gets faxed in to the IRS. You can fax it into the IRS or you can mail it in. Because the corporation had no prior tax year and was not incorporated until January, any S corporation election made before January 9th would not be valid. So you would not put an inception date for the S corporation that was before January 9th. And if you wanted it to be treated as an S corporation from its inception, from its formation date, then you would put January 9th on the Form 2553. You wouldn't put January 1st because January 1st, the corporation did not exist. Example number 2. This is when the corporation had a prior tax year. American Copiers, Inc. is a calendar year C corporation that has been filing Form 1120 for the past 5 years. So it's been a C corporation and it has been filing as a C corporation, Form 1120, for the last 5 years. American Copiers wishes to convert to an S corporation and make an S election for the tax year beginning January 1st, 2024. They want to be treated as an S corporation starting with the new tax year. In order to be an S corporation beginning on January 1st, 2024, the corporation must file Form 2553 on or before March 15th, 2024. So within 2 months and 15 days of the start of its tax year that it wants to be treated as an S corporation. The company cannot wait until the filing deadline of the next year to do that. If they do, then the S corporation election would be late. In order for it to be on time, it has to be filed within 2 months and 15 days after the start of the tax year that it wants to be treated as an S corporation. It was treated as a C corporation up until now, but now it wants to convert. Because the corporation was already in existence and has been filing as a C corporation in the past, it can also make the election at any time during the prior tax year, which would have been 2023, to make it effective for the following year, which is 2024. American Copiers, Inc. is a C corporation. It's been filing corporate tax returns on the Form 1120, and now it wants to convert to be an S corporation, which is fine. A corporation can convert to an S corporation, and an S corporation also can convert to a C corporation. They can. But in this case, the company wants to convert to an S corporation starting in 2024, which means they have to file the Form 2553 on or before March 15th, 2024, and they can also file it anytime during the prior year. Anytime during 2023, they can file it to make it effective for the following year, which is 2024. And there's a line on the Form 2553 that asks when the corporation was incorporated and also asks when the corporation wants to start being treated as an S corporation. So those dates are not always the same. In this case, it wouldn't be the same because American Copiers has already been in existence for the last 5 years, so it was incorporated 5 years ago. But now it wants to convert and be an S corporation for 2024, which means they have to file the Form 2553, the S election paperwork, before March 15th, 2024. Otherwise, it's considered late. Shareholder consent. If the S election is made during the corporation's tax year for which it first takes effect, each individual shareholder who holds stock during the year must also consent to the election. This is true even if the person may have sold or transferred his or her stock before the election is made. What this translates into is anybody who owns the stock during the year that the corporation makes the S election has to sign the Form 2553. You have to have 100% of the shareholders agree to the S election. And that's true even if it's a situation where one of the shareholders has already sold or transferred their stock. As long as they were shareholders in that year, in the year that the corporation is actually making the election, then they have to sign the Form 2553. An S election requires 100% shareholder approval. It's not like that with a C corporation. With a C corporation, you only need majority shareholder approval, which means over 50%. But with an S corporation, you need 100% of the shareholders, and they have to sign this form. The form includes a jurat, and every single shareholder has to sign it in order for the S election to be valid. And let me give you an example. Example, Harrison, Sylvia, and Nicholas are all equal shareholders in Salem Hardware, Inc., which is a calendar year C corporation. On January 5th, Nicholas decides to retire from the business. So he's retiring, he's getting out of the business, and he's going to sell his shares in Salem Hardware to Martha, his cousin, completing the stock sale on February 1st. 2 weeks later, on February 14th, Harrison, Sylvia, and Martha, who is the new shareholder that just bought these shares, vote to elect S corporation status. So they're doing this all in a hurry at the beginning of the year. And they're still within the deadline in order to make this choice because it's all happening before March 15th. The corporation must file Form 2553 on or before March 15th in order to make it effective for 2023. And all of the current shareholders must agree to the election. In addition, Nicholas, who is no longer a current shareholder because he sold his shares to Martha, must also consent to and sign the S election, the Form 2553, even though he is no longer a current shareholder and sold all of his stock before the election was made. This is because Nicholas was still a shareholder at the beginning of the year that the corporation wants to make the election. So even though he's not a current shareholder when the election is being made, he was a current shareholder in the year that they make the election. So in the year that you submit this form, basically, all the shareholders have to agree. 100% of the shareholders have to sign it. Otherwise, it's not valid. Note that this same rule does not hold true for S Corp conversions to a C corporation. So if an S corporation wants to convert to a C corporation, they only need the majority shareholders to sign off on it, over 50% or 50% or more. But if it's a C corporation converting to an S corporation, then they need 100% of the shareholders in order to agree. Example, Larry, Tim, and Karen are shareholders in Jumbo Candies, Inc., an S corporation that has been in existence for 3 years. Larry owns 55% of the corporate stock, and Tim and Karen own the remainder. So Larry is the majority shareholder in this case. He owns over 50% of the stock. Larry decides that he wants to convert Jumbo Candies, Inc. to a C corporation. Larry may choose to convert to a C corporation because he owns more than 50% of the stock. He does not need the other two shareholders' consent. So he can convert his corporation to a C corporation basically on his own. And he doesn't need the consent of the other two shareholders in order to do it because he owns more than 50% of the stock. But if this was a C corporation, it's an S corporation now, and he wants to convert it to a C corporation. But if this was a C corporation and Larry wanted to convert it to an S corporation, then he would need all of the shareholders to agree. And all of these shareholders, Larry, Tim, and Karen, would all have to sign the Form 2553 in order to convert to an S corporation. But the same does not hold true in reverse.